everybody, and welcome to our latest podcast in our Talking Sustainability series. My name is Silvana, and I'm here with Callum. We are both associates in the tax team here at Travers Smith.
Thanks, Silvana. So, back in April last year, we published a podcast on the concept of ethical taxation. And we commented at the end of that podcast that a lot had changed over the previous 10 years and that the world is likely to be a very different place 10 years in the future. Well, we're back already. And I think that just goes to show how quickly the role of tax in the ESG movement is evolving.
Exactly. And today we are very excited to say that we are joined by a guest on our podcast. We have Sebastien Akbik of the UNPRI here, who's going to talk with us about recent drivers for businesses to develop an ESG focused approach to tax, including in particular focusing on the EU's Sustainable Finance Disclosure Regulation, or SFDR, and the concept it is introduced of good tax governance. We'll talk a little bit about the theoretical tensions and practical difficulties that may arise from this, also the spectrum of approaches we have seen in the market, and some examples of steps that businesses could take to develop good tax governance. So, Seb, welcome to the podcast. Would you like to introduce yourself?
Yes, and thank you for having me. It's a pleasure to be here. So my name is Sebastien Akbik. I work as a corporate governance analyst at the PRI, so Principles for Responsible Investment, and I focus mainly on tax issues at the moment. So one word on the PRI maybe. So the principles were launched in 2006, and our goal is to help create a more sustainable financial system and to assist investors in achieving this by incorporating environmental, social, and governance factors into their portfolios and decision making, not just as the right thing to do, but also in a way that makes sense to the investment community. And we believe that an economically efficient, sustainable, global financial system is a necessity for long-term value creation. And PRI, prompted by a small group of forward-looking signatories, started working on the fascinating issue of tax back in 2015, when tax wasn't really that high on the agenda.
Great. Thanks very much, Seb. That all sounds really interesting. Sounds like you'll have some great insights to share with us. Before we dive into looking at sort of the recent drivers for progress, it's probably worth very briefly summarising on why tax is important as part of ESG, as perhaps it's not the first thing that brings to everybody's mind when they're thinking about ESG. So Callum, how does tax fit into ESG?
Yeah, I think that's a good idea. And at a very high level, I think you can probably pick out three roles for tax, which are advocated to different extents by different actors in the market. And they are compliance and transparency, fairness and sustainability, and incentivization for change. So taking those in order, firstly, compliance with applicable tax payment, reporting, and transparency requirements, including those which are specifically geared towards ensuring businesses have an ESG conscious approach to taxation. Secondly, fairness and sustainability, as embodied by what is an increasingly prominent school of thought, that businesses should be paying the right amount of tax in the right place and at the right time. And thirdly, proactive tax legislation and policy making as a lever for behavioural change. So, for example, tax reliefs to help incentivise and finance the development of solutions to climate change.
Great, thanks. I think that sets the scene really nicely for how tax is involved in ESG. And as we said, this is something that is being thrust more and more into the spotlight at the moment. So shall we explore a little bit what the reasons for why tax is being driven up the ESG agenda?
Yeah, that sounds like a good idea. But and before we come on to SFDR in particular, which I know is something we want to focus on today, I think it's worth making clear that there are a real range of different sources of pressure on businesses in this context, and they range from investigative journalism, like the Panama Papers, to the evolution of investor priorities, to national and international tax blacklists, and to OECD reforms. And Seb, it would be really interesting to hear from you what you think are the most impactful sources of this pressure. Would you say that the investors that you work with and represent play a significant role in this respect?
Yeah, that's a great question, and I agree with you. There are so many drivers for why tax is moving up on the agenda. One thing I wanted to mention is that in the current situation, we have on one hand governments and tax authorities being accurately aware of the billions that they lose every year to corporate tax avoidance. And on the other hand, you have government deficits due to the COVID-19 pandemic, which are only made worse by the ongoing energy crisis. So the result of all this is that we're seeing increasing government efforts to offset that revenue lost to tax avoidance. And a clear example of this is just over a year ago, 137 countries agreed to implement a global minimum tax of 15% for the largest multinationals, what is commonly referred to as the OECD Pillar 2 tax in the media. And companies themselves expect more tax disputes in 2023 because of the increased government focus on tax. And that is very relevant for the investors that we work with, because if companies expect more tax disputes, then this is going to have an impact on investors. And maybe quickly, last year, we saw the first ever shareholder resolutions calling on Amazon, Microsoft, and Cisco to disclose country by country reporting. And the important thing is that these proposals received more than 20% of votes in favor, which is significant for first-time proposals. And interestingly, Amazon tried to exclude the resolution from going to a vote, and investors with assets under management representing 3.6 trillion wrote to the Securities and Exchange Commission to allow the issue to go to a vote, and it did go to a vote. And in 2023, we're going to see another 3 shareholder proposals, which are very similar, targeting the US companies of ExxonMobil, Chevron, and ConocoPhillips.
Great, that's really interesting and it shows how important it is that good tax governance is for businesses in the current climate. And as we've mentioned previously, one of the drivers on this is the SFDR. This is particularly interesting because of the regulatory technical standards released in January this year, which prescribe the detail of sustainability disclosures which certain in-scope firms are required to make. Now, these standards specifically invoke tax compliance as being part and parcel of demonstrating good governance, although they don't provide any guidance as to what good tax governance actually entails. Callum, could you tell us a little bit about SFDR here?
Yeah, I completely agree. This is a really interesting development. And just taking a step back and by way of a very high level summary, SFDR is a transparency and disclosure regime which requires financial services firms which hold out their products as having particular characteristics to back up those claims by making particular disclosures to the public and to investors. And the particular requirement which you just mentioned, Silvana, is the requirement for firms which market products, so funds, for example, as having sustainable investment as an objective, and these are called Article 9 products, to provide investors with and disclose on their website information on how that objective is going to be obtained, including how it will make investments into investee companies which follow good governance practices with respect to tax compliance. And that's, I think, what we're going to dive into now as a concept.
Exactly. So good governance practices with respect to tax compliance, or good tax governance. What does that actually mean? Now, as lawyers, we like a nice, neatly defined term, but that's not the case with good tax governance at the moment. So we've obviously been having a think about what that means. But Seb, it'd be really interesting to hear your views and the views the PRI take as to what is good tax governance.
Yeah, that's an excellent question. And just the fact that SFDR includes tax compliance is yet another sign that tax is really moving up the agenda. So as you mentioned, it includes tax compliance, but it also includes in the Article 4 about principal adverse impact indicators that investment decisions must comply with. One of these indicators is about complying with the OECD guidelines for multinational enterprises. And in turn, these guidelines include a chapter on tax that says that multinational companies must comply with not only the letter, but the intent, the spirit of tax laws and regulation, and that tax oversight, so the oversight of risk, tax-related risks, is a matter for the company's board. So depending on their level of ambition, some investors might just do a basic screening for investee companies that are involved in tax controversies, for example, or those that have a more ambitious approach might actually try and assess if the companies that they invest in are complying with the spirit and not only the letter of tax laws and regulations. So perhaps I can talk about the recommendations that the PRI has set out for investors in terms of what they should expect from the companies that they invest in. So to start with, investors want to see companies setting out their approach to tax. So preferably in a publicly available tax policy. So that includes, for example, the company's approach to tax planning. Investors want to understand on what end of the scale companies find themselves in. Are they only looking at tax as a cost to minimize, or are they looking at tax from a broader perspective, including from an ESG perspective? And I think if you look at the UK tax strategies that large companies have to publish, you'll see some interesting nuances in the language that is used when it comes to the company's approach to tax. So some companies, for example, have very clear commitments that all the transactions that they conduct are motivated by genuine economic activity and substance, and that no transaction or structure, for example, is set up in a way that its sole purpose is to minimize taxes. So investors are interested in understanding these commitments from companies. Investors want to see evidence of good tax governance from the companies that they invest in. So that means evidence of board oversight, that this decision-making body is actively overseeing the company's tax strategy and that they are involved in monitoring the company's compliance with its policy, with its commitments. We think it's a very reasonable expectation because boards have to deal with an increasing number of ESG concerns now, but they all have financial expertise. So presumably that should be a reasonable expectation to add to their list of concerns. And we want to see companies ultimately taking ownership of their tax strategy and being able to explain it to investors. So some companies also include information on their internal controls or on the management of tax risks. So who's responsible, the reporting chain, the frequency of these reports, employee training, whistleblowing procedures, and not last but not least, for public companies, a key expectation, and I'm going to use another acronym that I think ESG professionals should memorize if they are interested in tax. It's CBCR, so country by country reporting. So that means that companies disclose basic information on the income taxes that they pay and other financial information like related party transactions, profits before tax, headcount, on a country by country basis to ensure that there is no artificial profit shifting from, let's say, a high tax jurisdiction like the UK, Germany, to a low tax jurisdiction. And I think the basic underlying principle guiding these recommendations is that companies can no longer afford to just comply with tax regulations and tax laws from a purely legal compliance perspective, but that they also need to comply with the intent of tax laws, because that's increasingly what is expected from them by tax authorities, employees, customers, etc.
Thanks, Seb. You've highlighted a really interesting range of factors there in terms of what might go into good tax governance, and just thinking about some of those factors, like scrutinizing the substance of a firm's tax policy and ensuring you're not contributing to profit shifting. Would you say that good tax governance is still fundamentally reactive and sort of focused on monitoring and compliance, or do you now think that the center of gravity has shifted to such an extent that the good tax governance now actually entails an element of activism? So, like you say, taking steps to ensure you're paying tax in particular jurisdictions and aren't contributing to base erosion and profit shifting.
I would say that everything starts with compliance and monitoring. That's definitely a prerequisite. But because the expectations from governments and employees, all the company stakeholders are shifting and have started to shift. I mean, you mentioned base erosion and profit shifting. The OECD has been working on that for almost 10 years now. The EU is introducing a flurry of legislations on profit shifting and base erosion. So businesses will be increasingly expected not to shift their profits artificially. So I think that good tax governance will increasingly include an element of activism if that means not contributing to base erosion and profit shifting. And a growing number of investors have expectations on that.
What does that mean then in terms of the actual amount of tax that businesses pay? Do you think the actual amount of tax paid has any relevance to good tax governance?
That's also a great question, Silvana. I think because one of our core expectations is that companies not just focus on legal compliance, but that they focus on complying with the intent and spirit of tax laws, it has some relevance because in some cases it might mean the company will accept to pay more taxes in order to get to that level of compliance. Now, I don't want to say that investors, for example, that are interested in the issue of tax want companies necessarily to pay more taxes, but what they do want is companies refraining from just complying with the tax laws from a purely compliance perspective, because that's not going to be enough anymore. So if the trade-off is that companies pay more taxes, but then they have more sustainable and certain tax rates, then that might be a good thing for.
One final question from me, Seb, on the concept of good tax governance. I'd just be interested to hear the extent to which you think good tax governance should involve holding your investors or your investee companies, sort of on either sides, to particular standards from a tax perspective. And we see this, for example, with the fact that UK businesses can be liable for the facilitation of tax evasion by their business partners under the UK's offence of the failure to prevent the facilitation of tax evasion.
That's a very interesting comparison. I don't think we are at that stage yet where, for example, investors could be held responsible in some way for the tax evasion done by their investee companies or their asset managers. But I think even in the absence of that, investors will be penalized anyway by the consequences of such behavior. And we might get there in a few years. So, for example, some pension funds in the UK have been criticized, rightly or wrongly, for their exposure to some funds located in tax havens. So a growing number of investors are definitely going to require that their fund managers respect certain standards or principles when setting up funds. So, for example, the avoidance of double taxation will, of course, remain a priority. So will adherence to some tax principles, notably on substance, as we've said. To the extent that investors want to be invested in companies that meet the expectations of their stakeholders, then it's natural for these investors to hold these companies to account on good tax compliance, for example.
Well, thanks, Seb. That's all been really interesting. Actually, what we're going to do now is we're going to take a break here because there's lots more we'd still like to discuss on this topic, and ESG and tax is clearly something that there's a lot to say on. So as said, what we'll do is take a break and we will come back with Seb at another time for a part 2 of this podcast where we will continue discussing ESG and tax. In the meantime, if you'd like to ask any questions or get any further details from us on this podcast, please contact either myself or Callum, and you can find details on our website.